afternoon. My name is Kent Skornia, President and CEO of Krilogy. I'm here with my partner, John McArthur, our Chief Investment Officer here at Krilogy, and this is your October market perspective. Johnny, let's get back right into it. We've had a great year so far on the market. Lots going on right now. We've got earnings coming in on the S&P. About a third of the companies have started. We have the Mag 5, Mag 7, depending on how you're looking at it, coming in this week. That's going to be a big deal. And then, oh, by the way, we have the election on next Tuesday and the Fed meeting following. A lot going on. What's your take?
Lots going on. I think really at this point of the cycle, it's really all about liquidity, as strange as that seems. We've got global money supply way beyond, from the COVID era, way beyond long-term trend, which is a factor. We've got almost 3/4 of the top 34 central banks globally cutting rates. Hasn't been that high since early 2020 during the COVID era. We've got 6 to 7% deficit spending. The debt in the system is significant. It's not a near-term issue. I think I would just say, the punch bowl's still at the party, and irrespective of valuation, certainly on a near to intermediate term basis, it really just doesn't matter as long as things are humming along, and they have been. Earnings have been fine, and as
long as we're still growing as an economy,
that's right.
You can still pay for the debt, right?
Yeah, I think that's a good segue. I mean, if we look at the Citigroup Economic Surprise Index, as a function of liquidity, that's been better than it's been since April. We're seeing profit margins at all-time highs, retail sales strong. We were just talking about, or I was talking about with a colleague, consumer sentiment is really good, and so that's a byproduct. I think when we look to fundamentals, though, it's a much tougher case. If we look at going back, a year ago, so October of 23, earnings growth expectations for next year in 2025 have only grown or increased by 1% to 2%, yet multiples have expanded significantly. It just goes back to that liquidity function. That's really the driving factor, and there are no signs that looks to be changing anytime soon, irrespective of who's president.
Well, and you know me, I'm always sort of like, I climb the wall of worry with the market, right? I'm always sort of, especially running the organization Krilogy, we are always looking out into the future. The question though is, the comparables are getting harder over year, and a year from now, what do these comparables look like?
It's getting much tougher for certain, and we're starting to see earnings breadth out of the large cap tech names that you talked about improve. They're not improving overly significantly at this point. I mean, earnings revisions generally have been a little lighter. We'd like to see that pendulum, frankly, shoot up to help justify and support price. But the comparables are getting harder. We're into the low to mid 20s from a PE, price to earnings multiple perspective. Again, doesn't matter on a near term basis, but from a longer term perspective, it becomes challenging. Plus, we've got interest rates surging up here again.
That's where I was going to go next. We had a drop in it. The Fed dropped interest rates at the last meeting by 50 basis points.
They did.
What are they going to do next week? And we've already seen interest rates creep back up. Now, that could be good, particularly for earnings in the economy, right?
You bet.
But it's going to hurt mortgages. It's going to hurt,
That's right.
Lending power. I mean, it's going to hurt some things.
Yeah, the 10-year Treasury for reference was around 3.6 when the Fed cut 50 basis points in short-term rates. The 10-year now is at 4.3. That's 70 basis points.
That's quite a move.
And you could look at that and say, well, that's great. It's a function of stronger economic activity. All is fine and good. Some of it could be concern from the debt construct that's kind of looming in the background. Combination thereof, hard to say. I think when we look, and Charles Schwab has a great slide showing when the Fed cuts rates for the first time in a cycle, and I think there's 12 comparable cycles going back to the 1950s. Strangely, I think naturally consumers want fast cuts to get rates down so that they can, refinance and get some relief from interest rate pressures. But ironically, if we look at the average drawdown in the S&P, actually a slowing cutting cycle is what we should be rooting for, because the average drawdown's like 7% compared to almost 21% within the first 12 months following a cut.
Which makes for the argument, could we actually have a pause here at the next Fed meeting and maybe go every other 25 pause?
It's a great question.
Pause. I mean, we might be seeing some of that ratcheting down a little bit.
We could. I think Chairman Powell has been very purposeful about communicating.
Yeah.
And so I think given that, I would expect that we would see another cut next week, next Wednesday. But he might, to your point, he might start the messaging of we're gonna reassess as we go, and maybe not go so fast as the market was pricing in just a few weeks ago even.
Okay, let's talk about the elephant in the room. We have the election coming up next Tuesday. Lots of emotions around the entire country going on right now. What are you talking to your advisors? What are you talking to clients about in terms of what it feels like to manage money in an election moment?
Yeah, I think, frankly, obviously none of us know the outcomes. I would tell you from a market's perspective, it really doesn't matter. I know that's hard for people to hear because there is such an opinionated society around one party or the other, and I think that's all fine and good. In the end, there's plenty of data that suggests that it doesn't matter. I think the risk comes in a much lower probability outcome when you have kind of a full sweep of the House and Senate and president with one party or other, because that's where real change can happen from a policy perspective. Yeah. And I frankly, the market isn't really pricing that in. I think that's the moment where things can get caught off sides. And
and I think if you get a full sweep left or right, the market gets nervous, because then they can actually accomplish things, and sometimes those accomplishments can be extreme. And the market doesn't like extreme. We like gridlock, so we can predict what's happening in order to run businesses and run enterprises.
You bet.
And one other thing I would just say is that my opinion, and I've seen this multiple times over. I mean, you and I have been doing this for 25 years, and anytime someone makes a decision pre or post election that is extreme in their portfolio, 90% of the time they get hurt.
Agreed.
A good example is I've had on both elections, or multiple elections, where people have gone all cash because the opinion of the winner is negative. And every single time they've gotten hurt. On the wrong side, they've lost money on the deal.
Without question, whether it's a go to cash, whether it's a sector bet, you name it. I mean, it's variable, and there's so many factors that come into play.
Yeah.
And, I was going to say, we've talked about in prior discussions, the whole inflation battle, and the Fed is definitely winning the battle, but perhaps the war's not over. And I think that's some of what the bond market is sniffing out. Again, irrespective of outcome for election, we're seeing kind of a resurgence in inflation expectations on a longer horizon, and interest rates are starting to show that. And so it's, that's something that we're certainly paying attention to.
Absolutely. Anything else before I give a closing comment?
No.
I love it. Well, thank you for all your time today. The one last comment I would say is, whether or not you're excited about the election, who wins or who loses, listen to this. We believe in the American people. The American people push this economy and these markets forward more than any politician can possibly do. So when you're thinking about your portfolio, work with your advisor, talk to them about how you're positioned, how it impacts your financial plan and what you're trying to do, and then always believe in America. For John McArthur, I'm Ken Skornia. Thank you very much for your time, and have a wonderful day.